It's everyone's least favorite season, tax season. And that means that time of the year where you get to figure out exactly how much you owe or are getting back. And if you often feel sick come tax time, well, you're not alone. So many business owners that I talk to are convinced they are paying too much in taxes, but are they? So before you spend your time looking for some shady loophole on TikTok, let's break down exactly how to know whether you're paying too much in taxes so that you can feel good about your tax return. Hi everyone, I'm Jamie Trull, CPA and financial educator for small businesses. And here on this channel, I love to bring you all the things you need to stay informed, organized, and profitable in your business finances. So please make sure to like and subscribe. All right, today I'm going to show you several things. Number one, how do you calculate your effective tax rate directly on your tax return? Then I'm going to teach you how to determine if that is normal or if there is room for improvement. And we're going to talk about when you really should be concerned about the amount that you're paying in taxes, and when you might need a new strategy or maybe even a new entity type. And of course, make sure to stay until the end because we're going to talk about something really important: the difference between paying too much in taxes and not saving enough for taxes, because they are different. So let's talk about what usually happens, especially for business owners. Maybe you had a great year. Maybe it was your first great year in a while. You made more profit. You got all your books together, sent everything off to your accountant, and you assumed that the money that you had paid throughout the year, either in estimated taxes or withholdings, would be enough to cover you. But then they come back with that surprise big tax bill. And let me tell you, these are the type of surprises that no one likes. And you probably immediately jump to feeling like this is ridiculous and you're being overtaxed. But remember, the amount that you owe at tax time is really just a comparison of the total taxes you owe versus how much you've already paid in. So someone else that has a much higher tax bill than you might actually be getting a refund because they paid more throughout the year. So how much you have to pay to settle up when you file your tax return isn't really a good barometer for whether you're paying too much in taxes. You have to actually look at how much you paid overall compared to how much you made. So let's break it down. I actually want you to go grab your tax return. You can pause this video and go grab either last year's or this year's, whatever the most recent one you have is, because we're going to grab a couple of line items from it. So here is what your federal 1040 likely looks like. And just a reminder, we're looking at this specifically for federal taxes right now, but you can do a similar calculation on your state tax return to see what your state effective tax rate is as well. Now, if I were to have you guess what your effective tax rate is, what would you say? Most people I find guess a percentage that is actually much higher than what they're really paying. And that's because you might be thinking about marginal tax rates. So before we get into this, I want to discuss the difference between your effective tax rate and your marginal tax rate. Your marginal tax rate is essentially the highest tax bracket that you are in. So the last dollar you earned is going to be taxed at the highest rate. That is your marginal tax bracket. That is when we talk about IRS tax brackets, that's what we're talking about. So this is from the IRS website, and you can see these are the marginal tax rates. So for instance, if you make, say, $250,000 or more, you might assume that you're being taxed at a 35% rate. But that's only true for the last dollars you make. The earlier dollars you make were actually taxed at a much lower level or potentially at zero. And that's how we get to our effective tax rate. Our effective tax rate is actually the average tax rate you're paying. So if you look at total taxes divided by your total income, that's going to tell you your effective tax rate, which is always going to be lower than your top marginal tax rate. Now, coming back here to our 1040, I'm going to show you how to calculate that effective tax rate. And that's the one that's going to tell you whether or not you truly are paying more in taxes than you probably need to. Now, this is going to be a lot of technical stuff up here, but ultimately what this is doing is pulling in all of your income from all sources. So any earned income, any unearned dividend or capital gains income, business income should all be being pulled into this income section. And there's usually going to be other schedules where that income is being calculated, but it gets summarized here on this first page of your 1040. So if you look at nothing else in your 1040, the first and second page will tell you a summary of all of it. So the first thing I want you to do is come down here to the line that says, this is your total income. That is line 9 on the 2025 report. Sometimes this changes around depending, but this is line 9 on this report. Now, it can get confusing when we're talking about income because there are multiple different incomes from a tax perspective. There's total income, there's adjusted gross income, there's taxable income, and they all mean different things in tax speak. But what we want to think about is what you think about as income, which is the total amount that came into you. Again, that's your profit from your business, plus your salary, plus any other income you made throughout the year. So we're going to use that number. Now, the other number that I want you to grab from this tax return for your effective tax rate is going to be on the second page. And that on this report is line 24, or the one that says this is your total tax. So again, this is pulling in all of the taxes you paid from a federal income tax perspective and also from payroll taxes, which is Social Security and Medicare. Again, this is not including state income tax because there's a separate return for that. So now I want you to do simple math. We're not talking hard math here. This is literally something you can do on your phone pretty easily. Grab this line 24, your total tax, and divide it by that line 9 total income. All right, I'm going to wait while you do that. Okay, so what percentage did you get? And was it higher or lower than you expected? Now, knowing this is really important because it's going to tell you whether there are opportunities that you might be missing out on to save taxes or whether you're doing pretty well. Now, you might be wondering, what's normal, right? Is my effective tax rate normal? Well, it's going to depend on your income level, of course. So at lower income levels, let's say at under 50,000 or less in total income, you're likely going to have a low effective tax rate, probably under 10%. And in some cases, if your business is operating break even, you might have a 0% tax rate. But that's not a good thing because it means you didn't make money. So I went out to do some research to find what average effective tax rates were. And I found some research. It's a few years old, but I think it's still relevant because we're talking percentages here. And when you come over to this, you can see that this is less than 10,000 over here, and it goes all the way up to more than $1 million. And we're also going to use this all federal taxes over here. So when we look at this table, this is essentially saying that for, again, people making, say, under $50,000, you're probably going to have under a 10% effective tax rate. And as you go up, you'll see it climbing, but probably not as much as you might expect. So again, even if you're between $200,000 and $500,000 in income, again, this is profit from a business perspective, not just revenue, then you're going to be in, say, on average, about the 22% effective tax rate. And what might surprise you is that even in cases where you make more than $1 million, the average effective tax rate is only about 30%. So I think what's important to note here is that this whole idea that we're paying 50-60% of our income in taxes just isn't true. Now, again, if you live in a high tax state, you're going to add that on top of this. So your number might be more than this truly. But for a lot of people that are not making millions of dollars, you're probably in the 25% or lower effective tax rate area. And that's honestly pretty normal. So how do you know when it's time to start looking at various different tax strategies? How do you know when you're really missing out on some opportunity? What I typically say is that if you have a tax bracket under, say, 20%, there's probably only going to be limited opportunities for you to save additional money. Now, they definitely exist. However, it's going to be your more traditional things like maybe putting more money into a 401k or a SEP IRA. That helps to shield today's earnings from taxes and lower your total taxable base. Now, if you're getting up there into the 20, 25, and up to 30, there might be some opportunity for you. For example, one of those opportunities that I talk about a lot on this channel is switching to be taxed as an S corporation. That is a great way to save on taxes because a part of your earnings do not have Social Security and Medicare taxes taken out on them. So that can be a big difference. This is also a great area to be thinking about hiring your kids. You can actually shift some of your income from a higher tax bracket to a lower or probably zero tax bracket, which is theirs. And then you can do things like contribute to a Roth IRA or even just pay their normal expenses for camps or for private school from those funds, essentially getting a tax break for those amounts. Now, if you are in a place where you are paying 30% or more of your total income into taxes, well, you probably want to get with a professional. I am guessing that there are a good amount of strategies that you can start utilizing to bring that tax rate down. But if you're saying, wait a second, my effective tax rate really isn't as high as I thought, maybe it's under 20%, but I'm still getting hit with a big tax bill at the end of the year. Well, that, my friend, is less about how much you're paying in taxes and more about how you're preparing for taxes. For someone like you, I highly recommend using some kind of cash envelope system to be setting aside money throughout the year for your taxes. If you know this is something that you need to do, definitely check out this next video, which is all about the cash envelope system that I use in my business, which, spoiler alert, is using Relay. Relay is my favorite business banking platform because it lets me set up multiple different accounts that I can use for different things, and it will automatically set aside, say, money for taxes at the percentage that I designate. So for example, if you know your effective tax rate is around 15%, you could be putting 15% of your income directly into that tax account all year so that you have it available when tax time comes around. And you can also use that amount of money to pay your estimated taxes so that you don't even have that big tax bill at the end of the year. So check out that video and also check out Relay if you want to get more organized in making sure that you are able to pay your taxes without a problem. I also have a super special deal right now going on with Relay where you can get $100 just for signing up for a account, and there's no account fee to sign up. So go check that out, jamietrull.com/relay. Now, the most important thing though, when you are a business owner and it comes to your effective tax rate, is making sure that you are taking all the deductions you are entitled to. And that might mean making sure that you have a good system for logging those deductions. It doesn't mean going and spending more just for the sake of deductions, but if you are spending that money in your business, you'll want to make sure you're getting credit for it and you're not having to pay taxes on it. That is one of the benefits of being a business owner. We get to deduct that stuff. Now, if you want to get your hands around organizing your finances, putting some structure to it, making sure you're prepared for taxes, and making more profit, then I definitely recommend checking out my book, Hidden Profit. In it, I give you all these strategies that I use within my business, and I have taught hundreds and thousands of business owners how to do as well. Plus, we have some awesome bonuses if you go to jamietrull.com/book. So to sum it all up, how do you know if you're paying too much in taxes? Well, you look at your effective tax rate and compare it to what is normal. And then you ask yourself, what opportunities exist out there for me to potentially save in taxes? Maybe S Corp taxation, hiring your kids, putting more into retirement accounts, or even just making sure you're getting credit for all of your legitimate deductions. And then the next question is, how do I make sure that I'm keeping things organized so that I'm ready for tax time and not surprised by my tax bill? If that's you, then definitely make sure to check out this video next, which is about the 5 bank accounts you should have as a small business owner. Hint, one of them is for taxes. And if you're curious to learn more as to whether an S Corp could save you money, definitely check out my S Corp Switch Masterclass, which goes into all of it and helps you determine if it could be right for you this year. Thanks for joining me. I'll see you next time.